RMB Private Bank's Segregated Balanced Fund invests in local equities, listed property, bonds, cash, as well as offshore assets. The portfolio's objective is to maximize returns for the investor over the medium to long term at a moderate level of risk. Now, Tony Cadle, portfolio manager at RMB Private Bank, joins us for more.
Thanks for joining us, Tony. Just to outline for the readers, the rationale. The viewers.
The readers are in Investors Monthly.
That's
viewers
right.
on CNBC Africa.
The viewers on CNBC Africa. Just the rationale for the fund. Obviously, RMB Private Bank, you're the stockbroking arm of the private bank. Can you just tell us what the rationale was for setting up a fund like this,
okay,
and who it caters for?
Firstly, we're not the stockbroking arm, we're the portfolio management arm. And essentially the rationale is that we want to deliver at relatively low risk an inflation beating return over the medium term. And if we do that, then we basically meet our private clients' needs. So that's really the major objective. And obviously we have institutional funds as well, which have to comply with Regulation 28. So this is really a Regulation 28 fund.
Okay, and is it true that most of the clients would be clients of RMB Private Bank? Because I'm just struggling to see. I was familiar with RMB stockbroking, and then we had RMB Asset Management, which merged into Momentum. So where exactly do you fit in the?
No, we're part of the private bank, part of the wealth segment, F&B wealth segment.
Okay, and in terms of the range that you'd like to beat inflation by, do you have a specific number that you use to benchmark yourself?
No, we don't really. You know, we look at established companies that have earnings sustainability, and they're companies of substance. That's where we really play.
Well, let's drill into a couple of your key holdings when it comes to the equity side of the portfolio, and perhaps kicking off with RMB Holdings. That's your biggest holding at about 8% of the fund. Has that been consistent?
Yes, no, we've got that. If you look at the financial sector and banks in particular, you're getting, depending on which banks you take, which banks you invested in, they're giving you earnings of around 20% on 11, 12 PEs. Now, retailers can give you the same kind of earnings growth, but on 16, 17 PEs. So, you know, that's quite a good growth plus value stock as we see it.
We've just come out of a property discussion, and given it was in Botswana, Redefine is a big play for you. So you're obviously backing the listed property game in South Africa.
Okay, I think if we look at that and bonds and our bond holding, if you look at the global scenario, we have a situation of low growth, both companies and individuals restructuring balance sheets. So in a period of, if you like, I won't say deflation, but disinflation. And under that kind of scenario, property and bonds do relatively well. So that's why we have the weightings.
Just on that, Tony, the listed property sector is benchmarked to inflation, is benchmarked to the bond spreads, and those
Yes.
have become lower and lower.
Yes.
In fact, to the point where, depending on what duration you're looking at, it could be very close to or less than inflation. So when you talk to clients and you try and identify ways in which to give them the real returns that you've set out as the benchmark for the fund, what are where are the ways that you're seeing that or doing that through your portfolio?
Well, inflation at the moment is around just under 5%, 4.9%. We think that both bond and property returns over 12 months should give you around 7%. Now, if you look at the FRA curves, they're suggesting another 50 basis points cut. If that materializes, and if the South African economy doesn't perform as well as we anticipate, and there is another 0.5% cut, that's going to give you in excess,
well,
in excess of 7%. So you're getting quite a nice handsome return compared to cash.
What are you looking at from an interest rate perspective? Do you see another 50 basis point cut coming?
We don't. No, we don't. We think interest rates at the moment will be basically on hold. But the last interest rate cut caught us by surprise. But it was basically due to poor manufacturing data and mining data. And the mining data is unfortunately getting worse, not better currently. So if the Reserve Bank want to stimulate growth, there could be another cut in the pipeline. We're
Okay.
not forecasting it at the moment.
Okay. Just in terms of the portfolio, I see that according to the last fact sheet we saw, you had about 17% of the portfolio offshore. Could you just tell us what the split is between equities and bonds there, and also some of the equities that you've been buying?
And also geographies, if I can throw in as well.
No, we basically offshore we're around about 50% equities, 50% in bonds. And it's largely biased towards North America and Europe. It's a large quantity or large holding, and we have about 15% emerging markets, other emerging markets.
Okay, so and in terms of the regulation, that's fairly close to the limit because you're allowed 20%, as I understand, to invest offshore. The provision also makes another 5% available for the portfolio to be invested in African counters. Have you got any exposure to the broader continent?
No, we don't. Not directly. Obviously, indirectly through
the
companies, the businesses that are the retailers that are moving north into Africa. That's where we are. That's our exposure at the moment.
Just going back to your overall tone, when you talk about disinflationary environment, obviously you're not overly positive about where the global economy is going, potentially even South Africa. Would that be a fair assessment?
No, I don't think so. I think what one has to be is be on your toes in terms of the changes that are taking place. And it appears to me that if you look at most economists' forecasts, global growth next year will be stronger than this year. And obviously, if you have a situation where Europe stabilizes, then we could have a lot more money flowing into Europe and or the United States. But I mean, if the economy grows in general, it's also going to feed onto emerging markets as well.
To me, Tony, there seems to be a very negative spiral downwards at the moment in the world economies. Can you give us the reason why you're bullish on the world economy rebounding next year?
We've got a situation where, we would think that America will still grow at about 2%. It's subpar growth, but we think Europe next year will come out of recession and be positive, so that's positive. So there's the opportunity of a reflation in equity markets. Not necessarily that earnings are going to drive it, but a reflation because the perception of a systemic banking crisis or some kind of collapse in Europe dissipates. That would be a driver of money into equity markets. And obviously, if that dissipates, you'll see money moving into emerging markets as well.
South Africa itself, looking at current valuations on equities, where do you think we're going to go, taking into account your scenario on the global economy?
While things are somewhat cautious in terms of Europe, our portfolio is positioned in terms of defensive counters, and it's worked marvelously for us up to now. Obviously, if things get worse, we will remain where we are, but if things get a lot better, we would have to switch from the defensive counters to cyclical counters.
Can I jump in with MTN? We're trading almost at all-time highs on MTN.
Yes.
What do you do with the stock at this level? Do you take your money and run, or are you backing MTN for the long
No, you
term?
just sit and hold it.
You sit and hold it.
Because you're getting a dividend yield of around 6%. All you need is 4% capital growth per annum to give you 10%, which is double inflation. I'm very happy with that. And analysts over time have been very negative on the earnings growth out of this company, and they've always been proved incorrect. So, I still think you get a 6% yield, and if you get a 15% earnings growth, you're getting a 20% return. I'm very happy with that for our clients.
Is there a particular reason when you look at it, the two companies in there, or the two companies in that space that are listed, Vodacom and MTN, do you favour MTN above Vodacom?
Yes, we have probably double the weighting to MTN to Vodacom. We have both those stocks, and we have a very high telecoms weighting in our space.
What's your level of conviction on BHP Billiton? Trading at current levels, are you accumulating? It's a big holding within your portfolio at just over 7%.
We basically at weight resources, but Billiton we overweight, and the reason for that is quite a simple one. If you look at resources, we've taken a defensive view, and that is that you want a company that has large open cast operations that are relatively speaking low cost, and that's the kind of issue we want to play. We don't want to play, I mean, obviously, unfortunately, in South Africa, we've got a lot of labour issues right now. So those deep level mines are suffering, production's down. And they're also very defensive. You know, they've got 25% of their portfolio in petroleum products. So that's another reason why we're there. We think that coal and petroleum are defensive, more defensive than some of the more cyclical type precious metals, and they're also very defensive in the iron ore and copper. So that's really why we want to be in that particular stock.
And Tony, where does that leave your view on Sasol, a company like Sasol?
Okay,
Well, you have about 5.67%.
Yeah, I think
in your holding.
you've got to. We slightly overweight, I think, our benchmark in Sasol. It's had a good set of numbers that came out. It doesn't look, their projects going forward looked as if they're only going to be about 5 years out. So it's really an oil price play at the moment. And we consider, in a whole spectrum or universe of investments, we like defensive stocks, and we think Sasol and petroleum is defensive.
One last question you've got time for.
I just have to ask you, there's been obviously the platinum mining story has dominated headlines. One of the things that hasn't been looked at is the effect that the platinum revenues generate for the balance of payments in South Africa. Are you more prone to holding defensive rand hedge stocks at this point? And has that balance of payments problem that we might have with the mining and resources experiencing the labour problems they have, does that affect your thinking at the moment?
It's obviously a concern because your current account deficit's widening, and that could mean that the rand goes out. But at the moment, we still have, because of the hunt for yield globally, we're still getting large inflows into equities and into our equity and bond markets. So consequently, that's offsetting it, but it is a concern going forward.